of the Productivity Commission. The Productivity Commission itself is part of the ESRC funded Productivity Institute that is formally based at the Manchester Business School. And NISA is a proud partner of that initiative of the ESRC to try and understand the productivity puzzle that the UK faces, and ultimately to think of policy proposals that will improve what can only be described as a desperately poor performance over the last dozen or so years. Delighted this afternoon to welcome our four witnesses, who I'll turn to in a minute. Francis Stack from Santander, Andy King from the Office of Budgetary Responsibility, John Llewellyn from Independent Economics, and Martin Sartorius from the CBI. I'm very glad to be joined today by a number of our commissioners in person, as well as a number online down the line. I hope that those of you watching online can see both of those who are in the building and those who are elsewhere today. It's an interesting innovation post-COVID is the ability to do these things in a hybrid way, but it's something I'm still learning how to do. So please forgive me if I screw up even more than usual, which is very likely. Let me also just make a point of thanking all my colleagues at NISA today for helping us put this on, particularly Issam Samiri and Max Harvey, who's the coordinator of the Productivity Commission, as well as our excellent, brilliant team in external affairs who've been helping us do the planning for this event today. And finally, if not least, I want to mention in passing two of our observers, one of our former observer, Stephen Aldrich, who's Director for Analysis and Data at the Department for Levelling Up Housing and Communities. We had to walk, what, 300 yards?
Long way.
A long way to get here. I'm very glad he was here. And also in the room today is Catherine Mann, a member of the Monetary Policy Committee of the Bank of England, but someone with a distinguished record in economic policy, who will be working with us later this year on the evidence on investment. Thank you very much for joining us today, Catherine. So today our focus is business investment. The focus on our priorities for this year in terms of the Productivity Commission is investment. We can divide that and cut that in many different ways. But today is strictly, as far as possible, on business investment rather than FDI, public investment, or other measures of investment that we don't have. So with that in mind, can I turn to the witnesses today? I'll start with Francis, Andy, John, then Martin, perhaps to give a very short introduction to yourselves, but also perhaps a top-line perspective on business investment. Francis, that's what you first.
Well, I'll introduce myself. Yeah, so I'm the Chief Economist and Head of Economic Analysis at Santander. I should say up front that everything I say today is obviously my views and do not necessarily represent Santander UK. Sorry, I have to make the disclosure. I effectively run all the forecasting and give economic advice to the ExCo members on the board, and we obviously do a lot of scenario analysis around stress testing. And inevitably, because we forecast the economy, we're always very interested in what's happening to productivity. And it was quite interesting. I've actually been asked to do a presentation next week around productivity and why it's important to a bunch of food and drink members. So this is quite timely, really, to be able to tell them how important it really is. And you know, it's obviously been obvious for many years that we've been lacking badly in productivity growth, and particularly against our peers. And many times I'm asked the question why, and it's actually very difficult. Well, it's very difficult in 2 minutes to give an answer to that question. And there's been a lot of discussion around mismeasurement, and I noticed that we're talking about intangibles as part of this, and I think that's quite a key area. But certainly from looking at corporate borrowing growth, which obviously quite important to in my job, to my bank, it's fairly obvious that borrowing is now falling back considerably, and business investment continues to be an issue. And I'm certainly looking forward to listening to some of my panel comments on this as well. But given the outlook for the UK economy over the next 5 years, and is for very low growth, to be quite honest, I think there needs to be a renewed focus on this. So I'm privileged to be able to sit here and be part of this process, which I think, is not just a government-led initiative. I think we've all got to be involved in businesses, academic institutions. Everybody needs to be involved in this. I personally been a little bit more involved on the skills side in terms of productivity growth, but to be fair, skills, it's business investment too, to a certain extent, a different kind. You don't measure it in the same way. Obviously, we think about spending on money and on automation and technological advances, but equally, businesses need to invest in people. So I have been looking at that, but obviously, from the point of view of this forum, we're very much looking more on the money side of things. But as I say, I'm extremely feel very privileged to be here today, and I look forward to listening to all the other comments that are made.
Very welcome.
Thanks very much for having me along today. My name is Andy King. I am the fiscal lead on the committee at the OBR. Previously the chief of staff there, and in previous guises worked on macro and fiscal issues in the Treasury. I think this question, when it was posed, I think the first thing to say about it is that it's just been a challenge for such a very, very long time. I think in all of the 20+ years I've been working in Treasury and OBR, the weakness of UK business investment relative to other countries has been a top issue, and naturally governments have been focused on trying to solve that problem. So it was one of Gordon Brown's 5 drivers of productivity. It was one of the ambitions in the Osborne Cable growth plan. It was front and centre in Rishi Sunak's tax plan this time last year. So the question really is, why has it proved such a hard nut to crack? And I think the simple answer is that there's no simple answers. A whole host of things come together to leave us with a low investment economy. It's not just the headline corporation tax rate or the capital allowance regime. Demand prospects and uncertainty about them are hugely important too. Causation runs both ways from output growth to business investment, and I think that makes life analytically challenging. So one of the consequences is lots and lots of remedies are tried. Some help, some don't. But the constant changing of policy settings is a source of uncertainty in itself. So my day job involves signing off the costs and yields of government measures. The annual investment allowance has come across my desk very many times. So it's been around for 15 years. It's varied from £25,000 a year to £1 million a year. The level has been raised or cut 6 times in that period. So that must affect businesses as they're trying to plan. I think the one thing I've been really struck by over the years is that the underperformance of investment is not just a business investment issue. It's common to we've been close to the bottom of the OECD tables in investment share of GDP across households, businesses and government for decades. And I think that means that part of, but clearly only part of, the diagnosis has to lie with finding a factor that is specific to the UK, but common to all forms of investment. And for me, the planning regime does seem like a likely candidate. It slows things down, it creates costs, it creates uncertainties. And I guess you have to worry that that might be particularly important when you think about the volume of investment that's needed to hit net zero, which Martin's boss put quite colourfully in his speech on Monday. So I could go on. Let me stop there.
Thank you very much, Andy. Excellent start. John, good afternoon.
Good afternoon, judges, and thank you for inviting me, and good afternoon to everybody else. I have a bit of a confession. When I read the rubric for today, I realised, of course, that it's about business investment, and I thought I don't know anything about that. And but some of the people here will. And I've always been interested and concerned with productivity, because right from the time in the 60s when I did my doctoral thesis, I've always been following that subject ever since. And so I found my mind drifting, however hard I tried in preparation for today, to other things than just purely investment. And so I do have some thoughts, but they might be out of place. But just a few thoughts. One is on that productivity growth is a macroeconomic phenomenon as well as a microeconomic phenomenon. I'd be happy to say a few words about that if it was useful at some point. I did even find myself asking if one should be expecting more than we've been getting, as a matter of fact. It's not absolutely clear to me how much we should be beating ourselves up, but that will probably become clear. And the third thing that I always find myself unable to avoid mentioning is measurement. Are we measuring things right? So that's a bit to the side of it, and therefore I shall like you, I shall be interested to learn what people have to say. But if you want to hear it, that's at your disposal.
Well, we have the three topics that you have. We'll come back to them, but I'd very much like your views. So prepare some answers along those lines, but not just now.
Thank you. And to introduce myself, I'm Martin Sartorius. I'm principal economist in the CBI. Most of my work at the CBI involves kind of macroeconomic analysis and forecasting of the UK and other countries, such as the US. And I also work on the CBI's business surveys, which many of you probably know about. Right now, I'm focused on the financial sector survey, but previously have led on manufacturing and distribution as well. And just a few thoughts for myself to kind of open up the discussion from my side. So as Andy mentioned, the UK really has a long-standing structural weakness in business investment, especially kind of when we compare ourselves to our G7 peers. And the current situation and kind of looking ahead does seem quite challenging. So just looking at our own surveys, investment intentions softened quite noticeably over the last year, reflecting a mixture of kind of headwinds like demand uncertainty, higher costs of energy, cost of finance, as well as the interest rates have gone up, and labor shortages as well, holding back investment plans. And when we look ahead, our own kind of CBI forecast expects the economy to fall into a recession this year, and business investment kind of will contract and end 2024 9% below its pre-COVID level. So no expectation there of a big change to kind of more sunny uplands for business investment. And kind of as my boss Tony Danker spoke about earlier this week and last week, we do have a growing competitiveness problem. So we have some long-standing strengths in things like ease of doing business, some leading sectors, fintech, life sciences, advanced manufacturing, some fantastic research being done at our universities. But other countries are now making big strategic plays in areas that will define the next few decades. So the biggest example being, of course, the US's Inflation Reduction Act, which just anecdotally is starting to draw investment in these kind of key green areas over to that country and away from the UK. Now, the simple fact of the matter is that we won't be able to outspend the US or potentially the EU if they create a similar scheme. Therefore, I think kind of today's discussion is really timely to kind of talk about our existing weaknesses and kind of think about ways where we can outsmart the competition and make the UK quite an attractive place to invest going forward.
Thank you very much, Ross. I just wanted one question, if I may. Quite rightly, you outline a number of issues at the moment that make it, if not disappointed, it's just investment is not going to perform particularly well in the short run. But is there any sense in which the structural problems that we face mean that the shocks that we are facing, that are faced by most advanced economies in the world, mean that we're more sensitive to them and our investment performs more poorly than other countries? Is there some trap here that we're in?
Yeah.
I mean, is that, it's all very well talking about day-to-day shocks, but if you go to every other country, they'll say they're facing the same shock. So why does our investment continue to perform so poorly? So just a quick response. I just wanted to ask that, given what you said.
Certainly. So I think just kind of touching on a couple of the points that I made. So one, kind of on energy. So the UK is facing high energy costs, even kind of compared to some European peers, because we create a big chunk of our electricity is generated from natural gas. So when natural gas spiked last year, electricity costs in the UK kind of jumped up because of that versus kind of some other European countries where kind of the mix of energy generation is a little bit different. We're kind of a bit less exposed to that challenge. And that's something that we've heard from especially kind of energy intensive businesses. And then kind of on issues like labor shortages, this is, I know, been a longstanding issue in the UK, but certainly kind of Brexit and kind of changes in immigration regime haven't made it easier. And that's kind of ties into some of the longer kind of, CBI asks about kind of looking at reforming the apprenticeship to kind of boost domestic skills, but also looking at more flexibility for shortage of occupation lists to really get in the skills we need for the economy.
Thank you very much, Martin. Very, very helpful and very clear. Now I'm going to turn to our first topic, which is trying to understand the size of business investment. And I'll turn shortly to Anton Muscatelli, who's at Glasgow, to take the lead on those questions. But may I also just remind people who are online that they're able to send us some questions or comments. I think the expression is down the line. Is that right? That's a bit out of date. Anyway, down the line, and I've asked them please to give us their name and affiliation when doing so, and we'll certainly try to answer those questions within the time of this session or subsequently, because we have your email address now. Anton, may I turn to you at this stage?
Thank you, Jagjit, and I hope you can all hear me. I mean, I wanted to follow up on some of the points you've already made, and because in a sense, as I think a couple of you have said, this is not a new problem. I mean, if you look at business investment as a share of GDP in the UK, it's actually lower now than it was about 50 odd years ago. But in the last 30 years, since 30 years or so, since 1990, it's moved from around 14% of GDP to just between 9 and 10% of GDP. So I wonder if you could speak to that, and again, comparing across countries, if you some of you have already mentioned what the issues might be, but also why and how this matters for productivity. Obviously, lack of capital deepening does matter for productivity, but if you want to reflect on the way in which this might be an obstacle for UK productivity. And then I know one or two of you have already mentioned sectors. There might be a sectoral angle on this. So I wonder if we could start with Andy, just to explore just the size of the problem and the fact that it isn't a new phenomenon.
Yes, well, as you say, it is just not a new phenomenon. The government reports that I mentioned, several of them, I was the junior official putting together the chart that showed that we were doing badly on these measures. And there is a statement at the start of each of them saying something along the lines of, for decades this has been a problem. And by my reckoning, of the what you might call the 20 or so older OECD member countries, on business investment, we've been close to bottom of the pack for most of the last 25 years. On other forms of investment, it's varied a bit more, but on business investment, it's been persistently low. And I think I would defer to others on whether there's a sectoral angle to that within business investment. But the things that are striking are many of the reasons you come to quickly. It's hard to see how the UK versus other countries is particularly bad. So if you take the situation right now, we have a relatively low headline corporation tax rate, a relatively ungenerous capital allowances system, not right now with super deduction, but in general. And that adds up to a kind of middle of the pack offer for business investment. So why should that result in a particularly low ratio? The other things that I recall looking at are things like, is the UK somehow particularly short-termist in its view for investment prospects, to do with how things are financed or how the stock market works? And as I say, the thing that I kept coming back to, that is because it's common to the other forms of investment as well. It's just whether the planning regime just leaves sufficient grit in the system and slows things down sufficiently that, you know, that's part of the problem. But I guess the last thing I would say is that it seems so persistent and relatively large that it seems to me very unlikely that there's one answer. There must be many things going on.
Thanks, Andy. And maybe if I could turn to John, is there anything you would add, John, to that perspective on the likely causes and the importance of this phenomenon?
Well, only is one brief thing, and I was just looking at what the numbers actually were between 2000 and 2022 for the growth of GDP per person employed, and actually, you know, in international comparison, we don't look too bad. I mean, the numbers aren't the sorts of numbers you'd like to see, but the US did far better than everybody else in terms of productivity growth. But really, UK, Germany, Canada, and Japan, there's nothing much in it, so we did fractionally better than Germany. The Italians look poor, with no growth in productivity at all. But the four that I mentioned, UK, Germany, Canada, Japan, pretty tightly balanced, nothing to distinguish between them. So, just on the facts, I think we could berate ourselves for the low investment by all means, but actually the productivity reform hasn't been that bad.
I shall maybe turn to Martin next.
Yep. Yeah, so I mean, just to follow up on John's point, so just in kind of speaking with businesses more recently, and when they're talking about kind of what is influencing their investment plans, a couple things that come up is one, kind of the recent chop and change and kind of policy and kind of strategic view of the government. So it's very difficult, including on things like tax policy, to plan investments which are kind of longer term, you're looking 5-10 years into the future. If you don't know kind of what the government's focus is going to be at that point in time, it's very difficult to make decisions. And the UK, especially kind of over the second half of last year, was a big victim to kind of this broader volatility in the policy landscape. And then really kind of, I mentioned Brexit earlier, but again, it's something that still comes up when we speak to members and kind of when making kind of both decisions on which countries to invest. Foreign-owned firms, kind of each country manager comes up and is making the case for their country to get the investment. And we hear all the time that it just becomes a lot more difficult for the UK to make a competitive case, because always they hear back from kind of the heads of these foreign-owned companies, but what about Brexit? And it's just something additional that they have to kind of argue for and kind of overcome those questions. So I think that those are just a couple things that kind of put us right now in kind of a bit more of a difficult space when companies are making those decisions whether or not to invest. And if I may just make a couple comments on kind of the sectoral angle of business investment recently. So kind of looking at our data on investment intentions across a few different sectors, manufacturing has kind of stood out as like relatively more resilient compared to services and distribution. And kind of a couple of factors that kind of may come into play into that, just based again on our survey data. One, you see a distinct boost in plant and machinery investment intentions, so probably reflecting some of that support from the super deduction. And that as well, kind of in terms of reasons of capital expenditure, many manufacturers told us that they wanted to expand capacity. And I think this ties into that kind of pandemic boost to kind of goods demand. And even in the last few months, we've still heard from manufacturers that they're working through their backlogs. So there's still kind of relatively kind of decent output on that side, because there had been such a backlog of demand over COVID. So that's a couple things kind of making it a little bit stronger in that sector relative to others.
Thanks very much, Martin. And maybe finally, Francis, maybe your perspective on the question, but also if there's particular angle from the financial markets side in terms of behaviors you see in the UK in terms of business investment versus comparable countries.
Yeah, I mean, a couple of things. I think the point about uncertainty, when I've gone out and talked to obviously corporate clients, that certainly is an issue. And part of that's Brexit, part of it's chopping and changing. But I think a lot of the clients I talk to are SMEs, and I think there's possibly a difference between, you know, how the SMEs feel versus how much bigger companies feel about these things. And certainly we've noticed from you know, data coming in from the Bank of England that SMEs are starting to, they want to pay back any debt that they've got. So I think from an investment perspective, at least now, they're much more focused on getting rid of the debt. And I can actually, I mean, from the point, I did write it down, yeah. So if you look at the sort of floating rates for an SME, they're almost, you know, 1% higher than for much bigger companies if they borrowed, and they have probably borrowed that way. So, you know, they're really starting to feel the hit now in terms of, you know, costs to their business. So they perhaps don't have as much money to make these investments. Having said that, we do, so Santander actually has something called the Trade Barometer survey, which it conducts twice a year, and they're mainly talking to SMEs around, you know, how they feel, sentiment and things like that. And, you know, it is quite interesting. Obviously, it's trade focused, so it's more interested in those companies that are looking to trade abroad. And it's quite interesting that they want to be able to do it. They would like to be able to invest, but the problem they face is they don't have the support. They're not quite sure where to look. They need some more, I think, more guidance and help. Actually, Santander, this is a bit of a plug, but Santander have actually now created something called the Santander Navigator tool. I do believe they're talking to government, sort of trade department about, but it's there to try and help solve this problem for obviously our clients and those outside, trying to be able to point them in the right direction. So I think that there are things that can be done to help to grow investment, but quite why we lag versus other countries is difficult. I have to say I don't really have a good understanding of that. I don't understand why we're so far behind, unless it is that we just don't feel that our businesses want to grow. Perhaps because we have quite a large proportion of SMEs, they don't feel that they want to grow outside of, or they want to keep within the bounds of what they know.
Thanks, Francis. Could I perhaps ask you, and Martin and one or two others may want to come in, but there's been quite a lot of talk recently around SME tax, R&D tax credits, and the way that changes to that may have impacted on the decision to invest specifically in R&D intensive SMEs. Have you got any thoughts about that? And Martin may want to come in on this as well.
I think I don't have specifically, or at least I haven't heard very much from the SMEs I've talked to about that.
Martin?
Just short comment from me, where I think it is kind of concerning. So just kind of looking through my notes, I believe that the R&D tax credits for SMEs were kind of made less generous than they were before. And that is kind of a concern from the CBI's perspective. I have kind of a stat of kind of every £1 in public R&D expenditure stimulates around £2 of private investment after 5 to 15 years. So that is certainly something that is a concern for us. And you hear kind of from smaller businesses, just when kind of trying to look at kind of innovation through business investment, which ties into a broader discussion on productivity, many times it might be more difficult for smaller firms to access the finance to kind of invest in intangibles they need. I remember speaking with kind of one merchant bank a couple of years ago, and for them, when they're kind of lending to smaller businesses, I mean, it's effectively a no-go because you have no collateral on things like software. So that is something that is a concern when we're looking at how to reduce productivity for SMEs.
Just coming on the R&D tax credit, because it's one of the few areas of investment stimulating policy where the evidence base is very strong, the one Martin just mentioned. But when you look at this from the centre, not only was the R&D tax credit for small companies clearly very successful in stimulating R&D, it was also, unfortunately, quite successful in stimulating abuse of the system because it was very generous. And you could really see this in the data that as people were learning what they needed to do to get your generous payment, that certain sectors that were not obviously R&D intensive were claiming a lot of tax credit. And you can now see this in the ONS data. The ONS have taken on the tax-based data for R&D as a national accounts thing, revising up UK R&D spending very significantly. But unless they revise GDP significantly as well, that seems, at least at face value, to say that the R&D was not as productive as we previously thought. And so, no, I'm from the OBI, I don't talk about what should happen, but you can see, I think you can see why the government was trying to rebalance the generosity of the various R&D tax credits, given what they were seeing both in kind of good use and bad use of it. That's very interesting.
Thanks, Andy. Jagja, do you want me to hand back to you, because there'll be commissioners also?
Well, certainly we can go back to commissioners if there are any follow-up questions. I've got a feeling John wanted to come in.
Yes, one quick point. Thanks, Judge. One quick point. I mean, Francis and others have talked about uncertainty. It's obviously important, although I would say I don't think I've ever spoken to a company who haven't said that the environment is uncertain for them making their business. And in the same breath as saying that, I'd say there is one certainty out there, and that's in the realm of climate change and global warming more generally, because that's driven by the laws of physics, which you either choose to believe or you don't. But my sense is that there's now a broad recognition across most of society that this is a real phenomenon, that it's an important phenomenon, and it's an area in which there's going to have to be a fundamental change in what we produce and how we produce it, and to some extent where we produce it. Now, until recently, I think that this discourse on that subject was that investment had to be helped in some sense by government, whether by regulations, whether by subsidies, whatever, and that has worked in some countries. For example, in China, it was a policy of the government to bring down the cost of solar cells, and my God, they've been successful. But we're now at a watershed, because in many parts of the world now, renewables are cost competitive with hydrocarbons. And so in a way, if a COP26 or COP27 or government policies are not as effective as you might have wished, that's suddenly become less relevant. And it's just a question, really, in my mind, that you can talk to serious people now who see that, who think they see the beginnings of a real wave of investment, both in the production of energy by renewable means, but also replacing capital stock which will use renewables, basically means electricity or hydrogen. So it is just possible, and I wouldn't put it stronger than this at the moment, but we may be facing a wave of investment that we haven't seen for a very long time. And it won't depend on policy, it depends on the laws of physics.
Well, certainly cause for optimism in the future, perhaps, but doesn't help us understand the UK's particular problem over the last dozen years or so.
Well, no, I mean, to what extent do we look back, to what extent do we look
Well,
forward?
we're trying to understand
Yes, sure.
the causes of where we currently are. I can see that Rachel, I have a question, but I can see Rachel is coming in, and if I don't obey that, I get into terrible trouble. Rachel.
So I just wanted, I think we've touched on this, but I just wanted to ask if people could add a bit to it. I mean, one of the big points that seems to emerge is the UK has been at the bottom of the G7 league for some time as far as business investment is concerned. Can we say more about that? I mean, has it just over time, has it got worse? Is it getting better? And also in terms of sectoral differences, I mean, is this located in any particular sectors? I mean, is the composition of our economy, part of the answer to all this? And sort of linked into all this, I mean, I keep on reading in The Economist that the real answer to all this is our planning system, and it may or may not be right. But has that got any support in cross-country comparisons? I mean, can you see that, for example, you know, things that require a lot of planning permission, like construction and whatever, is particularly poor, performs particularly poorly in the UK relative to other countries? So can we just sort of, can I just ask if people can go a little bit deeper on this question of why our performance on business investment is so poor, and whether it's something that's got dramatically worse or something that's just been chugging along for as long as some of us can remember, and some of us can remember a long time?
You're right, Rachel. I'm sorry to put you in the frame, Andy. Is that something you might be able to come back on? You, in a sense, you mentioned the planning issue, and I just want to know how important you think that is internationally, and I guess just digging into the sectoral questions of business investment to the extent that we can, and whether the business investment story is recoverable. Have we been bad for so long that it just requires a complete regime change? You may not be able to answer that, but I think it's where we're going.
So, I mean, just on the facts of where we sit in the league table for business investment, we've been close to the bottom of this kind of, as I say, the group of like older OECD countries, most comparable, and by bottom 2 or 3 places for as long as the data go, as far as I'm aware, and it has varied. We've had worse periods and better periods, but really that is a structural issue. I think there's definitely cross-country evidence that says that because we have a very service sector focused economy, you would expect a lower rate, but that cannot explain all of it. There's something large going on. I am not aware of good cross-country evidence of planning regimes or land use regulation on investment. I mean, to my mind, as I've said, the thing that I find striking is that across all sectors in the kind of household, business, government sense, investment is low. I think I take that as evidence that the planning regime is an issue. I mean, to give one piece of evidence from a while back now, but when in the run-up to the financial crisis, when across Europe and other parts of the Anglo-Saxon world, you saw construction booms. In the UK, you really didn't. You didn't get a construction boom, you got a pure house price boom. So as the financial excess was building up everywhere, it was only in the UK where it really didn't go into supply, it went into price. I may think that's a good or bad thing given what happened afterwards, but that, it's a piece of evidence that the ability to invest in real things is held up by something. And there has, of course, been some planning reform over the past decade, and the UK's relative position on housing investment is not as bad as it was 10, 15 years ago. So perhaps that's also evidence that it's an issue.
Thank you very much. Just one follow-up. Is there anything from any other commissioners who want to come in? Clearly, when we write down our simple views of business investment, one of the drivers for firms that are risk averse and facing uncertainty is the level of uncertainty and the level of risk aversion that they face. Something that is always and everywhere a phenomenon, as we've heard, that everyone talks about. But is there any sense in which we could say that it has been worse, the levels of uncertainty the UK has faced, than other economies, either because of global factors or the extent to which they interact with our domestic structures to make them worse, or the policy churn or the policy process that we've got? Is that an identifiable factor?
Yeah, I can.
Looking in your general direction.
It certainly is something that comes up a lot when we speak with businesses. Stability, policy certainty, all are kind of key things when making investment decisions, also kind of tax system certainty, and when those things are in flux, that makes firms kind of a bit more cautious about investing in the UK. And I think just looking kind of internationally, the UK has been going through kind of quite a volatile period over the kind of last 6 years or so, and that does stand out from kind of other international kind of peer countries, and it comes up all the time kind of when we speak with businesses. So yes, that's certainly, we see it as well kind of in our surveys, and just generally when we're talking with businesses, that theme comes up over and over again.
Please, Bob.
Yeah, can I follow up a little bit on the uncertainty question? I really want to go to John about this, because I think John was absolutely right earlier to say businesses always complain about uncertainty. It's the same thing like we had another conversation this morning. Businesses always complain they can't find the skills. I've never talked to a business who doesn't say that. The question with uncertainty, however, is whether there's a certain tipping point. It really goes to Martin's point that it seems to be building up over time. And one hypothesis, and that's why I was trying out on you, is that we might have accumulated an amount of uncertainty for some of the reasons discussed here, that we're now actually beginning to see a significant downward effect on investment compared to what we're seeing in other countries. How would you respond to that hypothesis?
Credible. And you do feel it's building. These things are very subjective, but yes, you do feel it's building. I would have added Brexit to that too, because it reduces the attractiveness, other things being equal, of placing your investment in the UK with the view of having unfettered access to a large market. So yes, I could imagine. I haven't seen evidence of it. I tell you what I have seen evidence of, just to Rachel's point, if I may. I was talking earlier the weekend to a lawyer in America who's concerned with planning. He said, by God, it's hard to get stuff done in this country now. He said, of course, you think we're geographically big. He said, but in the places you want to be, we're very crowded and it's extremely difficult. And I said, like the UK. He said, exactly like the UK. And he's been trying to place, he says, to place investment in the nuclear industry is damn nearly impossible, even on existing sites.
Well, I've learned a lot from that session. Thank you very much, everyone, for asking the questions and answering so fully. I want to move on, if I may, to intangible. By the way, I hope you didn't have to pay that lawyer by the hour. That's a bit scary and stirring. But I wonder if I may turn to you just to take the lead on the question of intangibles for the next 10 or so minutes.
Sure, I'd like to thank you for including this topic into the agenda, because intangibles have become an important part of the investment story in recent years. Intangibles was a rather esoteric topic until the 1990s. It was certainly not a core business for economists. But since the early 2000s, a whole literature has accumulated, plus measurement has accumulated about the importance of intangibles. And as we all know, even today already, we see that a significant portion of intangibles are included in our investment story. Research and development, software, significant parts of innovation like artistic originals and initial design. There's a part of intangibles that are not yet included in national accounting, but economists, among them, for example, Jonathan Haskell here in the UK, would argue that more of these intangibles need to be taken into account. And if you take that entire picture together, adding things like organizational capital and management competencies and brands and marketing, which actually are going to become part of the national accounts, the next system of national accounts. If you take all that together, intangibles as a share of GDP is significantly higher than the traditional tangibles as a share of GDP in virtually all OECD economies, if not all of them. Yes. So I think we need to discuss it, because we have to think about how does this exactly fit into the productivity story? And I think we still have a lot of sort of open parts there. And John, as you mentioned earlier that you are interested in measurement, I think the first question I'd like to ask to you is actually, do you think that we're on the right path with measuring intangibles? Some people would argue that maybe we're pushing this a little bit too hard, that intangibles are, well, intangible, so they're somewhat different from the rest, and maybe we're overdoing this a little bit. Some people are arguing against including marketing and brands into the investment concept. So let me start with you, what your thinking is about this movement, and whether you think that's going to be helpful for us to understand the issues with investment, or whether it's actually making it even more complicated.
It's a judgment call, of course. But firstly, on your numbers, I mean, we did look at them recently with some care, and I would very much support your numbers that that intangible investment is as important, quantitatively or more, now in the advanced countries. Which of course has a paradox in it, because investment's a lot higher than we thought it was, and our productivity growth is less good than we thought it was. But putting that thought aside and addressing your question, when we looked at the sort of the whole string of intangibles, at one end it looked a bit fanciful to call it investment, and at the other end it seemed dead obvious that you should. If you buy a computer for your office, it's fixed investment. If you buy software to make it work, it's intangible. That's obviously right to include it. But on the other hand, investment in brand was sometimes called intangible investment, and I don't think in economists' terms it is. And so I think some people are pushing it a bit. I agree with you. But I always say to my people, we've got to come up with a number. And we reckon that 2/3 of what was being recorded as intangible investment was almost certainly right. But that's a lot. Two-thirds of a half, say, that's a lot.
Yeah, so we probably have to live with the reality that marketing and brands are going to become part of investment at some point, since the national accounts movement is going there.
Yes.
But there are two ways now if you add intangibles to the story here, there are two ways to think about this if you relate it to tangibles. One is that, okay, this is just something that we didn't measure properly so far. It's been measured, but it was measured as a spend, and therefore it sort of took off the growth of GDP if it accelerates. We're just now adding it and we're recognizing it as investment. And so one argument is that, well, it's just a complement. The story doesn't fundamentally change. And actually, Bank of England, in a recent paper, actually, the first author of that was the governor, was arguing that this is sort of the missing investment story. And if we add these intangibles, we basically have explained the story.
Good enough, yes.
The other way to think about it is to say, no, there's something else going on, because there might be a reason why tangibles are becoming less important. And that is because they're being substituted for by intangibles.
Yes.
The economy is simply becoming more tangible. And so as long as we get too narrowly focused on these tangibles, we think there's a problem, but there may actually not be a problem. There is a substitution going on, and we have to rethink where we have to put our policy instruments. So how are you thinking about this? Do you think it's a complement? Do you think it's a substitute? Do you think we still don't quite know and need to figure this out?
I think there's three elements. One is it was something we always missed. We just didn't count it. We didn't realize it was becoming important. Partly it's a complement, because you need to invest in various intangible things to make your tangible capital work properly. And to some extent, it's a substitute, at least in a sectoral sense, because you move from machinery to digitization or whatever. So it's all three, in my view.
More work to be done there.
Yes, without any doubt.
Final question then, and then we can open up to some others, and maybe others of the witnesses may want to answer to this as well. And that is that some of these characteristics of the intangibles are different from tangibles. And it's been very well summarized by Donovan Haskell and Stephen Westlake, spillovers effects and sunk costs and synergies and so on. And there is a concern that some of the recent developments in intangibles are actually not as good in creating these spillovers and these synergies that we would like as they were before the financial crisis. So, we had a good round of intangible growth adding to productivity growth in the 1990s and early 2000s, but then since the crisis, it sort of have leveled off a little bit. And one argument is that because of digital technology and other movements, we are actually not generating these kind of positive effects from intangibles as we had in the past. Again, I'd like to start with you, but I'd like to also hear from other witnesses what their thoughts are about the power of intangibles, the significance of intangibles for productivity.
I think that question is too hard for me. I think it's the right question.
Disarming honesty.
Yeah, it's extremely hard, isn't it, at the margin to say, for example, an anecdote. I had a dinner the other night with the CEO of Rolls-Royce small modular reactors, right? Who actually encapsulates an awful lot of what we're talking about, because first of all, technologically, this country is 2 or 3 years ahead of its nearest competitors, who are French and American. So that sounds like a plus. But they haven't sold any, not abroad. And you say, why haven't you sold any abroad? Because they're about 30% cheaper than ones constructed on site. Answer, because we can't until we've had one or preferably 2 orders from the UK government. Why haven't you had 1 or 2 orders from the UK government? They can't until the regulator signs off. How long is the regulator going to take? 2 years. Is planning a problem? Well, it shouldn't be, because we would put these things on the present nuclear estate, as they call it. But the government says we have to take that very seriously, even though our soundings suggest that the people who live in the vicinity of the nuclear estate would love to have it. So there's your planning. And then last on this to your intangibles point, I don't know if it helps. Theresa May was there and she said, well, of course we'd have to train the people because this is a pretty sophisticated. She said, not a bit of it, not a bit of it. Sign us a purchase orders today, we'll train the people, we'll find them in any of the leveling up, any of the red wall seats. We can do it with our existing manpower, not a problem. And I just asked myself the question when I heard him saying this, is this a tangible investment or is it, because you wouldn't even see it because it's done within the company.
Any other witnesses want to comment on this question of whether intangibles are running out of steam, if I could use that sort of terminology? So that's a very tangible technology, by the way. But
that's really a big thing.
Anyone else want to take a crack at it?
I mean, I can just make a quick observation kind of from our survey data, again, kind of what the business view has been on the kind of intangible investment. There has been kind of a boost to it over the pandemic, especially when a lot of firms had to move to remote working and kind of updating their digital infrastructure. There was kind of a big push to kind of spend in that area. So that something that may be kind of slowing as we are kind of going into kind of back in person kind of meetings and workspaces, but that certainly kind of was a recent trend and it has held up kind of stronger than kind of other categories of business investment in some of our surveys. Kind of notwithstanding that, I go back to kind of my earlier point where I was mentioning about kind of funding for intangibles, where that can be an issue where there is no obvious collateral. So there's the possibility that for some businesses that may want to kind of spend extra money there that don't have kind of that internal cash flow to spend on it, that maybe there might be kind of untapped investment still for intangibles.
The only thing I'd add is big data. I mean,
Yeah.
certainly, I know, well, in our own business and in a lot of other tech businesses, they're really looking at big data and what they can do with that. I mean, I suppose that would be intangible, and that may well, but it's not quite. I just don't think it's there yet to be in that sort of monetized state where you can start to. But I think it's coming. I mean, certainly there's a real push all round, and that's partly to do with digital, which is interesting because if I think of digital, if I think of some of the benefits of digital, they actually go to the individual rather than the company. I think it's only starting to turn. I mean, you know, just from a banking perspective, being able to go on my phone, have the app, do it's done. For me, I've saved lots of time, but that doesn't necessarily get qualified as, you know, output that you would.
I was going to say, it's measuring
But it's
investment.
productivity for
It
me.
is. And we've got problems measuring the investment, and we've got problems measuring the output that comes from
Yeah,
it. Yes.
exactly. So it goes back to that sort of measurement point as well. But I think there are quite a few.
Well, I mentioned to some extent, you're also arguing the time lag element.
Yes.
We're still not seeing it yet.
It's just taking, it does take time to come through, but I think there are certain things, yeah, big data probably would be one of them.
I would actually question whether our statistical methods will ever, our present statistical methods will capture it at all. It's not just a little lag effect. I'm not convinced they capture it.
We have a question from one of our commissioners, Eileen Harkin-Jones. I wonder if we could bring her in here to ask the question. Thank you. Hello, Eileen.
Yeah. I'd like to ask the witnesses about how important they think investment in people is going to be in the future? And for example, in areas like management training, has it always been important? Will it become more important in the future? I think our younger people are going to have much greater expectations of, that companies are going to invest in them. But how important is this relative to investment in software, for example?
Well, I would certainly say from my perspective, I think it's key for a lot of organisations, particularly for the younger generation. They're interested in the organisation as a whole, what they stand for, what do they then want to work for them, and you certainly get the feeling that they want to feel that they're getting something out of it, rather than we say about going to work, we certainly have the policy that you need to be in the office as well, because you need to be able to build those relationships, but it's all about investing in them as well as helping the firm at the same time. So I think there will be a much greater push on that, and certainly from surveys I've seen, companies are talking very much more about, so upskilling their workforce has come to the top of the agenda, and that's presumably partly because they're struggling to get the labour that they need, but also keeping it. So it will be, I would imagine it's very, very high on organisations' agendas.
And could I just ask, how could we encourage, for example, our SMEs to invest more in people, and particularly in management training? What sort of initiatives are you aware of that have worked in other countries, and even locally in the UK, for example?
Well, I would put the problem the other way up sometimes. I speak to a lot of small firms and some medium-sized firms, but our clients are large firms. And most of the small firms I talk to, and we're a case in point, we put a lot of effort into training young people. And then what happens? Big companies come along and snaffle, pay the double, and on the back of the investment we've done. So I actually think the big companies are worse than the small companies when it comes to training, because they steal it. No.
Are we anywhere near understanding the extent to which intangibles are the substitute or the complement to future productivity? Any sort of gut responses from people? And one issue we have looked at, my colleague Isam has looked at this, is the extent to which intangible investment is financed internally by firms, rather than, I think Martin touched upon this a minute ago, is actually something that firms go out and use as collateral to lead to further investment. It's just something that they're doing internally. And I just wondered whether that acts as a constraint on the SMEs for investing in intangibles, but then that only matters if we think intangible investment is something that's important for productivity. So I'm finding it hard to cut through all of this as to how important it is.
I would say, from my perspective, yes, it's very important, because when we're looking at kind of key trends going forward and kind of the innovation space, digitalization, automation, all of these things need intangible investment. And so for the smaller businesses that want to kind of be competitive with the larger players and kind of really push the boundaries of kind of the next technologies and kind of offering the best service to their staff and to their customers, they need to be able to do that. So it's certainly a very important kind of issue, especially kind of when we're thinking about productivity.
So apart from the work we have at this, is the intangible investment that we've got, is it split by firm size? Do we know if it's largely concentrated in? No.
Yes, it is.
It is.
Yeah, yeah. I mean, to the
Sorry,
extent,
I've been aware of that. I just didn't.
yeah, I mean, to the extent that we have good firm level data, which is very limited still in terms of the breadth of intangibles. But to the extent the larger firms are the big spenders on R&D intensity, on other innovation, on digital, they're ahead of the smaller firms most of the time. So that's something element we very clearly see. Another really worrying trend at the moment is that some of the sectors that are most digital intensive right? The sectors that have actually seen the biggest slowdown in terms of the growth in intangibles in recent years, right? So one concern, that's why I was asking this question earlier, is that something changing to the power of intangibles, because it seems that those sectors that are actually using a lot of them do not really get that much productivity growth anymore. And that's why I think it's a matter of concern to think about it from a perspective of investment.
But what you've just said in the first part, that's consistent potentially with the view that SMEs might be underinvested in intangibles. And as part of the dynamics of firms, that might be holding them back. Which is a point that Francis was saying, is that arguably we've got too many small firms that aren't growing.
And it
We're
might
not
very
saying it's
well-
definitely causal, but it's potentially part of
And it might very well be related to Martin's comment that there's no market for intangibles essentially, and that therefore a lot of this has to be financed internally. But that can change over time, particularly as intangibles are going to create more, spillover.
We'll come with financing later. So
I was going to say, picking up on that theme, John's point is really important as well. Another reason why SMEs might underinvest, particularly in skills, that side of intangibles, is precisely because it's much easier to walk away with an intangible than it is with a tangible. I walk out the office with some knowledge stored in my head, but you'd probably notice if I walked out with an actual computer.
That is true to the extent that intangibles are linked to people. It's not true when intangibles are actually linked to the firm as such, right? So
I couldn't walk out with a Marks and Spencer's brand.
Yes, right.
very much. That is really helpful to understand this a little bit more, but not fully.
Sorry here.
Always got to make more research for ourselves.
Yes.
So we'll turn on to the third topic now, which is exactly being touched upon already, which is financing business investment. And I'd like Tony Venables to kick that off if you would. Thank you. Tony.
Great, thanks, Joe. So the supply side is access to finance the problem. What I'd like to do is sort of run through 2 or 3 questions, or 3 or 4 actually. First couple sort of descriptive. Do you think it's a problem? Is it a major issue? And then again on the descriptive side, where, if so, where is it most acute? Is it the sectors, types of firms, intangibles, regions, of course, spatial aspects. And then whether it's particularly a problem with different financing channels and institutions. Some bits of the financial intermediation just badly screwed up. And they're all rather descriptive issues, and then diagnosis, at some deeper level. If we've identified problems there, why do you think they persist? Okay, that's the sort of preview of what I'd like to do. Let me ask the first one of those. So I'm going to do the whole panel, I think, but sort of fairly briefly. I mean, is supply of access to finance, is it a big part of the picture, a big part of the problem in the UK relative to other countries, or not? Francis, and then we'll dig deeper.
I don't know about relative to other countries, to be fair. I think in the UK, I think it depends whether you're an SME or a much larger organisation, because if you're a large organisation, you've just got more, more scope to go to different places, equity, etc. But I certainly think SMEs probably struggle at the moment. I mean, linking it to the intangible point, you've obviously got to be able to put up some form of collateral, and what is not easy to do at the moment is obviously to value that. So it's very difficult for banks who, rightly have, they've got to go through a process to be sure that, we're meeting all our requirements, and that's obviously, regulatory focused. So I think it can be, I can't think that it's much, it's a much higher bar for, say, SMEs than perhaps others, which does, pose a problem for them. I don't think that so much it's, so if we take the current environment, that supply is so much perhaps the issue now. In fact, I just don't think there's that much demand for it versus the supply. But that's a present moment problem if we're looking at it, back through time. Perhaps less so. But yes, I mean, I think it's always going to be harder for SMEs. I mean, you know, the amount of information you need to provide is a sort of barrier to getting it. And so anything that can be done to ease that process for them. And, you know, banks are certainly looking at trying to make it as easy as possible, trying to provide the support that they need. You know, it's in, you know, banks' interest as well as theirs. So, but yes, I think there is I think there will always be a slight issue until we can help them to understand what they need to provide quicker.
Andy.
From the side of things that I've looked at these, like the SME financing gap has a longer pedigree than any of the challenges. I remember working on this back in, I guess, 2011, as we're trying to ease the credit crunch from within the Treasury, and Martin Wheel walking in and going, "Oh, the Macmillan gap." I had to Google it. But you know, one conclusion I took from looking at the things we were able to look at was that there's clearly a gap, but it wasn't entirely clear to me it was a market failure. Like that these things were mispriced. When you looked at the losses, things like the small firm loan guarantee scheme, they were colossal. Very, very high percentages went bad. And so, you know, it's SMEs are risky, right? And so in a way, the policy question is more one of the social return is higher than the private return, so they're subsidizing rather than closing a market failure gap. Now, as I said, personal reflections on something from 10 years ago, but you know, SMEs don't invest a lot in anything. The annual investment allowance, which is the plant and machinery capital allowance that SMEs use, 75% of firms don't make it. And so the SME side of things, it just seems to be a blanket issue as opposed to, you know, obviously a specific one. And you know, some of the conversation on intangibles was where you look at the Van Leeuwen work on management issues, long tail of poor performance. Then you look at successive government reviews of skills. You see a long tail of poor performance. Track it back through to early education, the problem in the curve looks the same. And you know, again, in my former seat when I was looking at policy, these things are very challenging to address because they look like they're quite deep seated and they have a start early life.
Yeah. Great, thank you, John.
Can't do better than anecdotes for you, really, is the truth of the matter. When we set our small firm up, we thought it would be interesting to find out if there was anything on offer from banks or whatever. But when you approach banks as a small putative firm, the degree of surety which they require just turns you right off. They wanted security, usually your house. They wanted certainty in the fact that you had to show them that you had earnings. We said, what the hell with it? And said to the bank in question, well, how are you supposed to set up a new small firm in this country? We were doing this as an exercise. We would be paid to do it. So we're investigating something which I do. So I'm afraid, sir, you have to do what everybody does, do it with your credit card. So that was the first anecdote. So I've concluded, because we've been approached various times since, now that we've been a firm in place for 15 years, people want to lend you money, and they start to show interest. They only start to show interest because you've been around for 15 years. Well, for God's sake. Then that's not purely anecdote, because I was at a private equity dinner with some people who used to run Lehman Brothers private equity, and then they took it over themselves. And at this dinner, they had private equity people from all over Europe. And one of the conclusions from the dinner was that there is absolutely no shortage of finance whatsoever for private equity. Because you've got a firm which is there,
And then the next step,
Right.
going out of private equity to.
Right, so they were swimming certainly in a pool in which raising finance was certainly not missing, which fits with what I was saying before. When you've got a firm which works, then you start to become of some interest. And then the other two anecdotes which go with it are that I've been surprised, because people are always blaming government for not supporting research, but you'd be surprised, at least I've been surprised, by how many people I've come across who've used government money as seed capital and got themselves a product, and then have real trouble financing it into the development stage. And the ultimate answer is they go to America. And if you're into anecdotes, I'll give you one more, which dates back a bit, just shows that this is probably right. When I was a fellow at St. John's, there was a fellow there called Fergus Campbell. He invented the night sight,
Okay.
which enables you to see when there's virtually no sight.
Yeah.
He's a patriotic Scot. He tried for 2 years to sell it to the Ministry of Defence, and they always told him reasons why it wasn't ready, they hadn't got money, they couldn't see the application. He finally lost patience, and he rang up a friend of his who worked for Eastman and Kodak in New York. He said, Fergus, what can I do for you? He said, well, I've invented a thing which can see in the dark. Fergus, where are you? I'm in Cambridge. Fergus, this is what you do. You get in a taxi, you take it to Heathrow. When you get to the Concord desk, there'll be a ticket waiting for you. When you arrive in New York, there'll be a helicopter waiting for you. We'll see you for an hour, and you can be home in time for bed.
Well, yeah, as I say, we're going to get to diagnostics, so I'm going to ask why. why that difference is there.
I don't know. And he's the most patriotic man I've ever met. He really wanted to sell us to the Brits.
Yeah. Anyway, John, and then, yeah.
So for my side, I mean, I'll echo kind of what my fellow witnesses kind of said about the kind of SME angle being kind of more the area where access to finance becomes an issue, but I thought I'd kind of bring in a little bit of the regional story.
Yeah.
Because I think that's really important. And a couple of years ago, I worked on a project with the Northeast Left looking at kind of investment as kind of investment potential in the region, and had a bunch of discussions with businesses and kind of public funding bodies as well. A couple of things I thought were kind of interesting to share with the group today. So first off, kind of on regional access to finance, when we're looking at kind of SMEs, there may be kind of gaps where the private sector is not really kind of funding or giving money to the credit to these smaller businesses, and that's where public funding can kind of come in. And I know now we have the British Business Bank that can kind of help fund that, but there was a feeling, at least when we did some of our interviews, that it hasn't fully filled the gap, kind of that was lost following Brexit. So that was a challenge that they were seeing in terms of kind of their portfolio going forward. And then additionally, regional proximity to finance also was an interesting theme. So this ties into some research that the British Business Bank did themselves about kind of around 60% of investing happens within an hour of an investor's office. And so when you go into regions like the Northeast, where it's quite a self-contained geography, it's not just an issue that it's far away from London, but it also is kind of far away from kind of more regional financial centers like Edinburgh, Leeds, and Manchester. And so that was kind of a big challenge, because especially with venture capital funding, those folks might not be willing to take the drive out to Newcastle or Sunderland to kind of invest in ideas or companies there. And that was a concern in terms of access to finance.
Great, thanks. So we talked about SMEs. Next question, what are the other particular areas where this problem may or may not bite? So regional is one, I don't know if anyone else wants to speak to that. Scale up or initiation, but then the scale up. Long-term projects in particular, is there short-term bias? Yeah, I mean, it's just a sense on, yeah, where, if there's a problem, where it's most acute.
Well, exports is the other.
Yeah.
Yeah, because we did a study on that once, and obviously the UK is at a disadvantage relative to a number of continental countries, partly its language, partly its proximity to borders and all of that. But there's clear evidence that SMEs underperform in exports relative to SMEs in other countries and relative to large companies in this country.
Because of finance.
Because, yes, I think so.
Access.
I think so. It'll also go back to intangibles, of course, because languages have part of it, but finance certainly.
Yeah.
Exporting is one of the areas where our SMEs really do underperform.
Yeah.
You agree with that? Yeah.
The language, we should have an advantage in the UK, not a disadvantage.
No, not at all. You sell in their language, you buy in yours.
Yeah. You learn others.
Has that got worse after Brexit?
Sorry?
Has that got worse after Brexit?
I don't know.
Can I turn to funding channels? And we talked about banks a little bit, but obviously venture capital, the corporate bond issues. But I believe the UK has the private sector stopped issuing any, almost anyway. So again, whoever wants to address this issue, are there particular funding channels, institutions that don't appear to be functioning particularly well in that core task of funding private investment? I mean, Francis, I could put you on the spot.
Yes, I think there are people who can answer this, but I couldn't provide the evidence. Venture capital is undoubted. There's more. If there's risk involved, you've got a better chance in the US than you have here.
Yes.
You agree with that? Yeah.
I think it depends what you're trying to finance as well. Certain, and that may be sort of sector industry bias.
Well,
things.
yeah.
I think actually just going back to your point about long-term investment, I actually think it's potentially harder sometimes in the UK. I mean, I can only, one thought was, back when BT were thinking about, do you do fibre to the home or do you do fibre to the cabinet? They went with fibre to the cabinet, partly because it was a 5-year return, and they've got shareholders that need to be paid, and that that was certainly a consideration. This is anecdotal, but certainly that was an issue, and I imagine they're not the only company that have that sort of issue. So I think it does depend a little bit on sector as well. But I don't know of any market that's not working, not working well at all. But I think it does partly depend on what we're trying to achieve.
Yeah, so the interaction with corporate governance is obviously important.
There is one other thing I would point down, which I should have said in the same breath, and that is that there's a cultural element in this, because we in this country apparently are not as good as the Japanese and the Germans at the large companies supporting their suppliers. And that can include access to finance. They can do, a large company can do quite a lot for a trusted supplier, because it can give it a contract which guarantees it a flow of income from a long term, which means it can borrow against that. And of course, it can provide finance directly itself. I think it's cultural, and I think the Germans, from what I understand, the Germans and the Japanese are quite good at it, but we don't do it so much.
Can I sort of follow up? Indeed, with some sort of why questions. Let me start with the regional. What is the real sort of barrier? I mean, why do you have to be within 60 minutes of this is difficult, but obviously it's hypotheses, if not evidence.
I mean, there's the long-standing issue, especially if we look kind of to the north of England, with infrastructure and kind of the links there. So, I mean, that may play a role in kind of when we're considering proximity of those links for train or roads. So that might be kind of a constraint on access to finance, possibly.
I know for foreign direct investment that the EY attraction the survey found that was one of the key issues. sort of transport links and things like that.
Yeah, you sent
Yeah, but that,
Sorry.
you sent some.
Oh, I can do that.
Yeah, no,
No, I have to write it down.
There's no
otherwise I
immediacy,
forget to do it.
Martin mentioned distance. And in particular, he said distance from London. I think he's probably putting his finger on the dead hand of London phenomenon a bit. And I'm asking myself the question whether, compared with other parts of the world, including Germany and including the US, the fact that there's more regional involvement helps. I did once do a study in which we looked at Cleveland and Detroit, both of which had sunk almost to depths which you'd scarcely imagine. But Cleveland had pulled itself out. And the study was, why did Cleveland succeed and why didn't it? And the answer is that each had a mayor and therefore felt he had local responsibility. And each was extraordinarily, the Cleveland one was extraordinarily entrepreneurial, induced back Clevelanders to come and put their plants there, worked on the banks and so on. So I think your distance point is actually probably very important, particularly if allied with political entrepreneurism.
yeah.
Bringing it very briefly on the regional point, designing work at the regional level, providing incentives for better politicians and decision makers at the regional level who could drag things up, because we've had experiments at the regional mayors that haven't really worked. I think it's something you've been thinking about, we might want to ask.
Well, so I think the specific question I'd like to ask is, to what extent is it a problem that so many financial institutions really are headquartered in London, and yes, they do have branches and so on, but they may not be working in quite the way also with call centers, and this question of distance, that you mentioned. But to what extent, would regional sectoral banks make a difference, say, if we compare it to other countries, or do we have to just redesign the way that banks are working so that, for instance, SMEs could lend on more competitive terms? They have access to finance, but I think it's the question of how competitive that access is, rather than whether they have access to money or not, because they clearly do. I mean, every large bank is on every high street across the country. I guess it's whether it's comparable, right? Whether you're trying to lend, say, in Cambridge, Oxford, or Reading, compared with, somewhere in Cumbria.
Kind of answer both the two of those points. So one on, I did speak with kind of a bank recently that is interested in kind of its improving its offer on leveling up and kind of regional offering as well. But one of the issues that they were facing is just kind of the knowledge base for them. They're a national bank, but still it's an issue for them when they're like, okay, we want to invest more in the region, but maybe we don't have that on the ground kind of expertise of kind of the business landscape, and that becomes a challenge because these deals may be riskier. So even though they want to kind of invest, to kind of makes them a bit more cautious. So I think that's kind of one thought that I do think it's positive that banks are thinking about it as something they want to address, and they want to look for additional sources of information to kind of overcome that problem. And then secondly, kind of on your other point, some of the research I've done, financial literacy does come up as a problem for kind of SMEs. So some may rely on traditional bank loans that kind of looking into their high street bank and say, okay, this is the type of funding I can get, rather than alternative sources of finance. So things like equity finance, angel investment, venture capital. So there kind of could potentially be a role, at least when we did this report with the Northeast Left, for kind of local government to act as an honest broker, kind of linking up kind of SMEs to potential alternative forms of finance that they might not be aware of before.
Are there any more questions from questions on this question of financing business investment? I just wonder if I could have one final question directed at Andy. You said earlier that the measures of short-termism, UK didn't look much worse than other countries. Just want to know what data you have to support that, but also it's kind of smart, I guess, Treasury points about this, that small firms are always riskier. So I see you saying that there's a world in which it's going to be more difficult for them to raise investment. And the counterpart is that banks will also treat them as riskier and ask for more information, which makes us end up in an equilibrium, in a sense in which it's very hard for small firms to find access. If they're treated as risky, banks are treating them as risky, but potentially the people setting up small firms have other disadvantages that we could outline that make it more difficult for them to negotiate the system and get the kind of loans that we've got. And if they're sited around the country, I think this point about, if you're lucky enough to live in an area of high net worth with liquid pools of venture capital on your doorstep, maybe you can go to a fundraiser meeting and get venture capital. But how exactly do you do that in other parts of the country?
Yeah.
And so my question always is, if we've got a sense of, are we worse than other countries to which we'd like to compare ourselves with these kinds of problems? Is it better in Germany? Is it better in Cleveland? Along those dimensions. You kind of said, maybe we're just the same as everyone else. I'm not sure about that. Perhaps I misunderstood you.
I'm not sure.
I apologize.
I think the issue of is the UK excessively short-termist? I just think it keeps coming up in the policy debate. I've learned more today from the analysts have been saying. So I don't have data on that, but my understanding from the fact that it does keep going up is that maybe an issue. Yes, I mean, as I said, the way the conclusions I took away from that, which was some time ago, was that at a kind of macro level, you could kind of see why the SME funding gap was there, like the risk is high, and that therefore, but the returns are high, and the social returns could be high. So it seemed perfectly reasonable, and you could see why, over decades, and all countries have ways of trying to subsidize the growth of small companies. So I think that was all I was saying. Not like the market is perfect. You can just understand why it's difficult for SMEs to find finance, because when you look at some of these schemes that do try to subsidize their way through the problem, the loss rates on guarantees are quite high. It's just, to me, says that that is a fiscal subsidy to something that you want to happen more than the market would deliver. As a OBI, I don't have views, but that's perfectly acceptable policy choice. Again, I feel like it is a policy choice to subsidize something rather than to identify somewhere where there's a huge failure.
Thank you very much. Cecilia, good afternoon.
Hi, Gajit. Yeah, sorry, just quite interesting. Earlier, I think there's a point to raise about the differential pathway between Cleveland and Detroit. Currently, I'm analyzing the data, not at the regional level, but look at combined authority and local authority district level. What I find something is quite interesting between Liverpool City region and Greater Manchester. Both have high employment growth since 2015. Both over 10% since 2015. But what I find is the trajectory, the GVA per hour growth is very different. Greater Manchester actually make very good change over that period of time, better than Greater London. But actually Liverpool was stagnated. So I think there may be an issue. If we focus on the regional level, you conceal a lot of disparities in England, at least, especially because we have a very unique political system. With the mayor are different, they have different setup, and I think that is something that quite interests me, especially earlier I mentioned the American case. So just want to hear more on that. Maybe later on in the policy discussion we can connect that to that. The other issue I want to raise about planning, as a town planner, I have to raise. Wherever people complain about planning cause problem, when we're inquiry, we've gone through with Dame K. Barker, with various people go to do inquiry. Yeah, planning system have problem, but the whole world's planning system have problem. The UK is quite unique. We have a discretionary problem. We have discretion. Central government can make the guidance, and the planner and local authority will exercise the discretion. So in theory, this system should be more responsive, more able to adjust things. If you look at the US, actually, why it's so difficult? Because they do zoning as well. To unzone things is actually very difficult legally. Now, I don't mean each system have pros and cons, But I want to say is we do a lot of research. No matter which system you are, you try to think you have zoning, you want more flexibility. You have flexible planning, you want more certainty. So that's an ongoing debate. But I will not say that that is the only factor. That will be something. Yeah, I will say that we need to look in it, because either way the system do have problem. It is a very bureaucratic system. So how we can make best to have business, that's something maybe, again, that will be something to discuss. But I feel the current government is flip-flopping. They can't make up their mind. So they have a planning white paper, they discard it. So that does not give certainty to business either. If the government can't make up its mind, are they going to make certain reform and then they change their mind a few days later? And actually that causes a lot of uncertainty to business, I think.
Thank you very much, Cecilia. I think, is there any immediate response to that? Can we take that as a comment we will think about more?
I think the French entertain less objection than we do to planning inquiries.
Oh, yeah.
Quite a lot. They're quite autocratic.
You don't say.
Yes,
Yeah.
And it becomes, I think, quantitatively important when you're talking about siting of nuclear sites. When they decided to put up a set of nuclear sites around the coast, they simply did it.
Yeah.
I did speak to one French senator involved. I can't resist telling you this. I said, you seem to be different from us in this respect. He said, in France, when we drain a pond, we don't consult with frogs.
Well, we certainly couldn't say that.
You may say that. Thank you, George. This is recorded on. Anyway, we'll move on. Now, I forget where we are. We're at Easter, right? It's Thursday afternoon. Policy. Now I'm going to move on to a session and where I've slightly less time than we envisaged, but I very much want to bring in Dirk Pielak, who's recently stepped down from his key role at the OECD working on productivity goals, and delighted he's able to join us and the Commission, but also today. Dirk, I may turn to you for some time on policy, and then perhaps in about 10 minutes, I'd like to ask Adrian some domestic questions on fiscal frameworks and the development bank. Dirk, good afternoon.
Thank you, Jagit, and pleasure to join all of you this afternoon. Great discussion also. I thought the issue of planning is something that I think is coming up in other productivity commissions at the moment. Ireland has been thinking about that. I wanted to really perhaps try to wrap up a little bit the discussion on policy, because we've addressed quite a bit of it already. But there's one issue I think we haven't really spoken about that much, which is really the role of public investment to leverage private investment. So I was first wanted to ask a little bit about that. I mean, there is quite a bit of literature about the role of public investment on infrastructure, but also in areas like public R&D to leverage more private investment. So I would be interesting to hear a little bit about, first, does it play a role in sort of leveraging private investment? And secondly, I think a little bit if the witnesses could say a little bit about initiatives they know about that have really been quite successful in this area, and any lessons we can learn about that either in the UK or abroad. So any thoughts on that? So really the question is a little bit, can this public investment play a role? Do we have any examples, and can we learn from that in certain ways? So anybody who would like to start on that, most welcome.
Thank you very much. Well, perhaps we could just go from left to right. Francis, would you mind? Would you be able?
No,
would you mind?
no.
Oh, sorry. Landed you in it.
Well, I mean, I certainly think that public investment plays a key role, particularly around infrastructure. One wonders with things like broadband whether there had been a bit more public investment, we would have been able to have been a little bit more successful in rolling out to each and every home, which is extremely expensive. But I'm trying to think of some initiatives, and I might have to come back on that one. Successful initiatives. Yes, I'm struggling on that one at the moment.
That's fine. We can come back in a minute. Turn to you.
Well, I mean, I think the answer is clearly yes, that public investment can do a lot to capitalise or implement private investment. I think the evidence base is, this is somewhat trite, but some investment is good and some is not, and the returns, the kind of variation on the returns is quite great, and that's one of the challenges. And then an allied challenge in the UK has obviously been ups and downs of public investment over the years, and that public investment has been cut very sharply in the mid-late 90s, then again after the financial crisis. So far in this consolidation, although there has been some cutting of the extent of growth in plans, is to a level that is quite high by at least UK standards, if not internationally. But again, the things that we used to look at in the Treasury back in the day when I was there, I'm a good Treasury official of those years. The Eddington Review of Transport is something that dear to my heart. Small projects that deal with bottlenecks that have very high returns are the kind of things that you would expect to boost productivity by boosting the capacity of the private sector to invest. But then, of course, there are the big projects that have done that as well. The Docklands, Jubilee Line extension, and the rest. That's a major project that had major returns. And then there are those very expensive ongoing ones that the case is less clear.
So, very briefly on something that Stephen points out whenever we meet for coffee, is that you can't be sure of the returns on public investment. You have to be very careful. Was there any sense, maybe it's a research question for us, is there any sense in which the variance or the unanticipated variance in the returns from public investment is any greater than we would get from private investment? We talked earlier about the riskiness of private investment. Wouldn't that have just the same level of variance, but it gets absorbed by capital buffers or the bankruptcy of the firm involved? There's a kind of natural exit of it here. Is there any sense in it there's any greater variance from the public sector? Or if we don't know, that's fine. But it just struck me when you gave the answer.
I'm not sure about whether there's evidence of greater variance. I mean, the evidence that underpins things like the optimism bias adjustment that's in all central government appraisals is based on cost overruns of private and public, I think, projects. But the large public projects, there is a very long list of those that have cost overruns and time overruns that are enormous. And I'm afraid I don't know whether how that lines up with private sector, but it is a fact of public sector large scale investment.
To be fair, I never thought about that question until you made your statement. It just occurred to me. Should we carry on along the line? John?
Yeah, perhaps just one quick point on Andy's comment here a second ago. I was just wondering a little bit whether those time and cost overruns are partly linked again to the planning discussion we had a second ago. Is that one of the big bottlenecks here, or is it more generally about, because some of the planning issues you probably have less to some extent sometimes with some of the private investments that we're seeing?
I think that's part of it. I mean, my understanding of the evidence of it is that it's often linked to ministers changing and changing their goals, whether it's in a major or minor way for the project, and that requiring the project to stop and plans to be reworked, and time and cost with time and cost implications. So you see that particularly with IT projects. I spent my OBR career watching the rollout of universal credit, which until the pandemic struck, it proved itself hugely successful in dealing with very large influx, was a story of each time the IT was ready, the system was changed and the IT had to be reworked for another year. And it was quite painful for those involved.
Thanks. John, perhaps you want to come in?
Well, I think one partial answer to the question that Judge posed is that one purpose of public involvement is to reduce that variance. And just to substantiate that point, if I may, in the mid-90s, Jacques Attali called say that he had this idea, and it's all a lot of hand waving, for a bank which would have capital subscribed by the member countries, would be used for the development of Eastern Europe, would undertake investment projects which the private sector would not undertake, and would make a profit. And when he left, the Secretary General said to me, "What do you think of that, John?" And I said, "Well, the case for investing in Eastern Europe is clearly very strong, but I wonder about making a profit, because," and here I confess, I was very Anglo-Saxon. You see, I said if it was profitable, the private sector would do it. Well, in the event, the EBRD was set up, and it has been spectacularly successful in the sense that all sorts of investment has been undertaken, which the private sector wouldn't have done on its own initiative, but which it joined very readily. Now, why? And I think it's important to understand why. Why did it join? Well, they did very careful investment appraisal, which was done by experienced investment bankers who they paid the market price to, they recruited from the investment banks. You'll be pleased to hear they put their chief economist on the investment committee because he had to sign off on the country's macroeconomic policy, because he said there's no point in putting in place a good, or they said there's no point in putting in place a good plan if the macroeconomics goes to hell. And he could veto it at any point, even afterwards, in subsequent withdrawals. And so they actually influenced the evolution of the country's macro policy and hence its environment, and reduced that variance. So I've come over the years, after having had to eat my words, to conclude that yes, there's a case for public-private sector involvement, but as always, that case depends on how well you do it. But they did it extremely well, and it was highly effective.
We need to write these anecdotes up as a book.
Sorry?
We need to write all these anecdotes up as a book.
Martin?
No.
Yeah, so yeah, I think the one thing I would mention here, where kind of totally agree with kind of public investment, helping crowd investment from the private sector on infrastructure skills. Yeah, I mean, I agree with that, but one angle that I think would be interesting is kind of where the public sector investment can help kind of de-risk and encourage investment in kind of growth markets. So things like decarbonization kind of being one great example where the government can help with setting up. We have offshore wind farms, but also providing a strategic view into kind of technologies of the future. And that's where kind of sometimes we hear some challenges from member businesses where, for example, I spoke with a company in the Midlands that does kind of in the green transport space, and they had felt that the government wasn't as clear on kind of whether or not they should go for kind of hydrogen or electricity for certain transport. Exactly. So I think that's where kind of there can be a bit more done to kind of give that strategic view, as I said, on kind of where business investment kind of should be flowing over the next 5-10 years. And in terms of kind of just some other, I think, noteworthy examples tying into that strategic viewpoint, I think the vaccines for COVID-19 are the perfect example of kind of where we had government funding, guidance, speeding things up with kind of a real vision, combined with private sector investment to get to a really successful outcome where the UK clearly was world-class. And so I think that that's one important one to raise.
Thank you, Martin. Well, I think it's the last 10 minutes or so now, so if Dirk will forgive me.
Yep.
To Adrian, if I may, who wants to ask some policy-related questions to the UK, and I want to wind up on.
Well, I had one other question left, Jagit. I think we haven't really had the more broader question on what are the problems perhaps in the UK, just to wrap that up a little bit on, you know, what's the problems in the UK landscape and what are some of the things that you might want to maintain. I mean, we've had 5 minutes now on policy, which is a bit little compared to everything else we've been talking about. So it's a bit of a shame to cut this short as quickly as you're doing now.
So it wasn't clear. Adrian will pick up exactly that point, talk about policy. Thank you, Dirk, very much. Adrian.
Yeah, so I think I'll start with the question about the British Business Bank. We just talked about the EBRD as an example, you know, of what can be done. So very specifically, do you consider the size of the British Business Bank adequate in the way it's operating or not? And if you think it is adequate, why, and if not, why not? And what would be added? I mean, I'm looking to both Francis and Martin, but of course, everyone else is equally welcome.
So I won't make a comment on the size of the British business bank, but some ways in which it can kind of, it's been done a good job, it can even do kind of better at its goal. So some ideas I kind of, when speaking to colleagues, there are things kind of like more independence for the investment strategy over the longer term. So kind of within 5 years or month of Parliament, that can kind of help with our broader discussion on kind of improving business investment in those funding gaps for SMEs. That's just one suggestion that kind of came up. I'm sure Francis, you have some other points to make.
Not, to be honest with you, not specifically. I mean, I will be interested to see how it fares against what's happening. But no, I can't really. I don't have any specific ones.
Okay. Second area would be to ask you about the impact of the current fiscal framework. You know, how is that affecting business investment? And would you say that on balance it's helping or not? And if it's not helping, what might some of the aspects of the fiscal framework that aren't helping? I mean, we already had a discussion about public investment, how often it's the object of cuts, and that clearly is a problem. So is there something that's missing from the fiscal framework that should perhaps put greater limits on when you cut capital investment and how? Especially at a downturn, when I suppose you might say that's just when capital investment is needed.
So I've got 3 areas that kind of where there could be improvement, and I think as well I can refer to kind of Tony's speech from earlier this week on kind of how to reform, but kind of there are 3 main areas kind of working on policy consistency and direction, which we've talked a lot about before. Also, the other challenge facing the UK is international competitiveness on subsidies. So with, again, going back to the Inflation Reduction Act and potential EU competitor scheme, so we can't compete at that scale. So it's big areas where we need to outsmart the competition and be very decisive on our direction for kind of bringing in investment. And then the other bit is on the tax system. So we're kind of in a situation where the tax burden is going to go up while we're also reducing incentives. So that kind of makes it more challenging to kind of be an attractive place to bring in investment. So I mean, just to kind of touch on quickly some of the kind of bits on improvement. So kind of the CBI has been calling for kind of full expensing of capital investment following the end of the super deduction, things like reforming the apprenticeship levy to kind of boost investment in skills, planning reform to help achieve our goals on growth and net zero, and then as well regulatory uncertainty, where for some sectors like say chemicals, they get very nervous, especially when we're looking at the kind of EU retained law bill. Many of them don't necessarily want divergence, they want to be able to export their products easily. So kind of reviewing, retaining, and reforming where appropriate those laws are another kind of big factor, I think, for business going forward.
Okay. John, do you want to comment? Okay, I do have a final question for all witnesses, which is what aspect of the current UK economic landscape, or more specifically the policy landscape, do you think are favourable to business investment, need to be preserved, but also which really need to be tackled? Just if you wanted to mention something that hasn't yet been mentioned in the policy landscape. So maybe, I don't know in which order, but I'd like to put that question to all 4 witnesses. Andy, would you
go first? Thank you. Mainly because you know, I'm definitely not permitted to start any sentences with should when it comes to policy. So let me just point to a few things where, you know, the UK clearly scores well on international comparison. So flexibility of the product market, labour market, competition regime. These are all the overall So all the the structural underpinnings of the economy as a whole, and therefore business investment. So there is a long list of things where you draw the chart and the UK is on the better side. So we talked about quite a few of those where the UK is on the worse side. So it's not.
It's interesting you mentioned competition, because I mean, arguably, over time, perhaps competition has not improved, but perhaps in certain sectors become rather more restricted. Do you still think that, on balance, the competition environment is a favourable aspect of the UK?
Last time I looked, defer to
Certainly a fear, and I know. I was talking to Martin Donnelly about that too. Former permanent secretary, and he said that one of the things he quite liked about being in Europe was that the bureaucratic process was so slow, and it was very difficult to be influenced by commercial interests as a result. And one of the things he fears is that now we've broken loose, political influence, lobbying, and so on government policy will become greater. Now that's forward-looking, which I know you don't want to do, Treasury, but it does strike me that is an issue going forward, because competition policy is very weak in most countries. I mean, Americans, although they invented antitrust, it's feeble to the point of uselessness. And we've probably weakened ours. And I think there only ever were two components to a good competition policy. One was international trade, because that exposed you to competition from abroad, which in some sectors outside the political purview. And the second was bureaucratic inertia, which Europe provided rather well. And now the UK, I think, will prove more responsive to that, and that would be to our detriment.
So you're saying a good competition policy would help business investment?
Well, bad competition policy hinders it. That's for sure. That is absolutely for sure. Because a bad competition policy gives you monopolism gets less.
Yeah. And certainly, and again, this is US data largely, but there seems to be increasing monopolistic power across many sectors. It's not clear to us right
Yes, I mean, when you think that the four big things now are Amazon.
So we know the list, we can't remember.
We know the list, we can't remember, but they have cash savings of 1% of world GDP.
Sure. We are approaching the hour, and I promised, as far as everyone's finished on time. Can I just ask one final thing? I mean, there was an issue that, for whatever reason, and I should say that we have two further evidence sessions this half year, on the 8th of March. We'll be looking at the relationship between public investment and growth directly as the whole of the evidence session, rather than business investment, which is our focus today. And also in May, on the 18th, we'll be looking at FDI. So some of the issues we've touched on today, I've been very grateful for such wonderful answers, and also questions from the commissioners will certainly give us a platform to delve more into these later in the year and produce a report, I would imagine, towards the middle of the year on the basis of the analysis that we've got. But it just the question is, and you talked about this, John, the quality of the EBRD and its success. Is that something we should be doing, a development bank for the UK to help business investment across the board, whether it's small or large, public investment that combines with private? Is it part of the infrastructure that's currently missing? Is development banks?
It's worth a go. But I think it has to be accompanied by that determination to actually make it work. In other words, you don't just provide the funds and say off you go. I think you have to get a cadre of people actually run it and make it work, and they've got to have their reputations have to depend on it. But yeah, I think it's worth a go. I really do.
I won't ask Andy. Martin, Francis.
Anything that I think can help bring the public and private sector together is a good thing, because you get the benefits of both worlds in that. So, yeah.
Well, I don't think the CBS is specifically on.
What do you think? Come on. Okay, fine.
Yeah.
I'll ask you later.
No,
Speak for yourself.
Can I make one observation? If I hear this whole conversation afterwards, extremely interesting. I think what I come down to, and please, and in a way, I sort of a question to you, and correct me to sort of provoke you a little bit, is, Martin, you said it very explicitly a couple of times, but I've heard you also say it's policy consistency and clarity on direction. And that's what I sort of hear over and over again. I was so triggered by your comment, John, just a minute ago about, that you said, like, okay, the problem in the UK is that we may now be captured too much by lobbyists.
Mhm.
Well, except for Washington, there's probably no place where there's as many lobbyists as in Brussels.
Mhm.
But I think the difference is that there is an institutional stability that creates policy consistency and direction, which is the way that you actually benefit from lobbyists without having that to take over. So that was just one example where I thought it. So provoking is a little bit whether that's a bottom line, and setting up a lot of new questions. How do you achieve policy consistency and direction in the longer term in order to create a better investment climate?
I know it's in a way a truism, that's what I said before and what I'm going to say again, but I think if you engage in these exercises, you have to put a lot of managerial effort in making sure that they actually work. I mean, I've always been impressed by NASA in that respect. I mean, it spends vast amounts of money.
Yep.
It started doing something which the private sector would never have done. But it has systematically, and I don't quite know how or why, but it has systematically engaged the private sector whenever it could. It bought as much as it could from the private sector. Not only did that, but it always made sure it had at least 2 suppliers, partly so that there would be competition and partly to generalize technology into the economy. And it's worked quite well. And I would never have guessed when I saw NASA put its first rocket up that you'd now see private enterprise doing that. It always seemed so quintessentially a national government exercise. So as a policy of industrial development, it hasn't done at all badly. But you could imagine that amount of money being absolutely wasted.
Mm-hmm.
So it does depend awfully much on the management and the quality and the determination to make it work, which means, I suppose, you have to write down a good rubric, which, to be fair, Attlee did, and I thought he didn't.
Mm.
And then you've got to pursue it with people who know what they're doing, and that is where the EBRD scored, because they had an economist on the board talking about the macroeconomics. They had investment bankers on the board talking about appraising it. They had finances on the board who said how you structure the finance, and it added up to packages which were credible.
Well, we certainly look at that and try to understand which structures that combine the private and public sector have seemed to have worked. Let's have a deeper look at those.
I think that's the issue.
I should finish then just by thanking everyone for participating today, for those who joined us online, for the commissioners and their support over this process, and my colleagues at NISA, but particularly this afternoon, not witnesses Francis Hack, Andy Keane, John Llewellyn, and Martin Sartori. Thank you ever so much.
Yeah, thank you.
Okay, 3 minutes. Well, hopefully we'll lose. I don't know.
Pretty comfortable, isn't it?